Welcome to How to Retire on Time, a show that answers your retirement questions. This is a live show, and we're going to be taking your questions. As always, submit them either on the chat if you're joining us live on Zoom or anytime during the week by going to retireontime.com/ask. We got kind of a fun show today. We're talking about the subtle things that people don't think about that erode or prevent a retirement plan from making a big difference. So that and so much more. Get your live questions in right now, either in the chat or so on. If you're tuning into one of our broadcasts on the radio, just remember you can always go to retireontime.com, join our newsletter, and get access. We only send this invite to those on our newsletters to join us live. We've got the feeds going up here. All right, David. So before I talk about the things that slowly erode a plan, I want to ask you a question.
Okay.
I did not prep you for this before the show on purpose.
Nope, this is coming at me cold.
Usually I give you a softball heads up. If you had to name the top 3 most deadly creatures in the world, what would they be?
Probably some kind of spider, some kind of snake. What would the third deadliest creature be? I guess maybe some kind of big cat.
Okay. Snakes are number 3
Okay.
on the most deadly.
All right.
Okay, snakes are number 3. Number 2, humans.
Oh.
We forget to include ourselves in a category. So humans contribute to the second highest amount of deaths in the world.
Okay, I guess that makes sense.
So, a little bit of a trick question, I'll admit it.
Yeah.
But at the end of the day, like, we hurt ourselves more than all creatures, all but one.
All right.
The number 1 most deadly creature in the world is,
I'm ready.
Mosquitoes.
Oh, yes, of course.
Mosquitoes lead to more deaths than any other creature in the world.
Yeah.
That little annoying thing that gets your blood and you slap it, but when you get dengue and you get all these other viruses.
Yeah, malaria.
Malaria. I've never had malaria, but
Zika virus, right?
that's pretty rough.
Yeah.
The reason why, well, first off, let me tell you how I found this out. My son said, hey, what are the most deadly animals in the world?
All right.
So we pull up AI, and I'm thinking, okay, we're going to have a conversation about sharks and tigers and bears. Oh, my. And like, none of the results were expected. I think tapeworms were on there as well. Like, the small creatures are the ones that get you. And if you look at it from a quantity standpoint, how many people are getting mauled by a hippo? I mean, really?
Yeah, that's pretty rare, isn't it?
We're not all, like, actually fighting hippos.
Yeah.
So we forget the little things that can make big differences in our life. That was kind of the point of the question.
All right.
So when it comes to a retirement plan or your portfolio, what is the thing, and this is a leading question, what's the thing we all want?
Unlimited growth.
Performance.
Yeah.
Yeah. Unlimited, to the moon. And that's a very important thing. It is. We all want growth. Undisputed, no problem. And the last 15 years, guess what we have received?
Pretty good growth.
Grow, baby, grow.
Yeah.
That's what our markets did. But growth, there's 2 factors here. Risk does not equal growth or reward. Risk means growth potential. So sometimes, like, humans are the second deadliest animal or creature in the world. Sometimes our greed can actually reverse the growth that we seek. And I cite, among many other people on this, I've written about this extensively in Kiplinger, even in their magazines as well, that flat market cycles are the most dangerous 10 years of market performance that you could possibly have. And the problem with it is there's enough time in between a flat market and then you got 20 years of up market and then a flat market. There's enough time in there that we forget that they happen.
Right.
It's like that used to happen. It doesn't happen anymore. Or that happened to them, but it won't happen to me. Emotional behavior really can pull a factor in here. No, I'm not saying that everyone should just do a 20-year CD ladder or bond ladder, right? That's got inflation risk.
Yeah.
And you either have market risk or you have inflation risk. You can't have one without the other. You can't not have at least one of them. But the point I'm trying to make is, what are the other factors that people are missing constantly when it comes to retirement planning? So I've got a list right here. This is based on the research of Vanguard, Morningstar, and Investnet on basically looking for the alpha in retirement. The little things, the mosquitoes that suck your plan dry and you don't even know.
Okay.
You ready to dive into this?
Yeah,
It's
let's do it.
very interesting when I was doing this research for the show. So the first one is tax efficiencies. I can't tell you how much of my life is focused on tax planning. Now, when I first started in this industry, over a decade ago, oh, we don't give tax advice. Just get them in here. Here's our model. Our model's great, and we'll give you your income and go see your CPA about taxes.
Yeah.
Well, your CPA, he ain't talking about how to be proactive with your tax minimization. He's saying, here's what happened. I can tell you what happened. I'm not looking forward. You got one professional looking into the rear view mirror and the other looking ahead in the front view mirror, the rear view mirror and the windshield.
Yeah.
That's a crappy situation because you're in the middle and you are compromised because they're not communicating. Let me give you an example. All right, David, congratulations. You have $1.4 million.
Oh.
You're 62 years old, though, so give you a few years.
Okay. I don't know which is worse there.
Yeah, $1 million
Better.
in IRA, $400,000 in your brokerage account. Now, a lot of people at this point in their life are going to say, well, I'm 62 years old. I've got till 70 some years old, whatever it ends up being for you, 73, maybe they put it back to 70 and a half, 75, whatever. You're going to have RMDs.
Yeah.
And so you're going, yeah, I got this IRA balance. I want to start working that down. And so what you do is you take some income, maybe you push out Social Security a little bit because you know about Social Security optimization. So you push that out a little bit. You're doing IRA to Roth conversions. You're not concerned about IRMA because you're at 62 years old. All is well, right? And you let your brokerage account just grow. Here's the tax inefficiency because you're not connecting the dots here. You probably don't have a huge issue with RMDs giving the income that you'd want and the account size balance, assuming that you're focused on maximum income. So that's not really that big of a deal. You're solving a secondary or a tertiary issue, not the primary issue.
Yeah.
What you really have is a huge opportunity by taking the $400,000 of long-term capital gains, your brokerage account, and in 62, 63, and 64 years old, only taking income from long-term capital gains. That equates to 26 to 36 extra $1,000 of less money that you're paying to Affordable Care Act insurance and or in taxes.
Because the capital gains are taxed at a lesser rate.
Yeah. So if you're married finally jointly, you've got the first 100,000 of gains that you can realize and pay zero taxes. And by the way, that's not a situation where if you go $1 over, it's all taxed at 15%. People get this all wrong.
Okay.
As long as there's no ordinary income pushing up your capital gains bracket, you only focus on capital gains for the first couple of years. That's a pretty cool situation.
Yeah.
And you can do all sorts of things if you're 61 years old. You're going to retire next year to rebalance it so you have incredible tax efficiency for a couple of years, knowing that when you turn 65, you'll start doing your IRA to Roth conversions. You'll keep your tax at a certain level and that you've blended your income with RMD efficiency. But we think, oh, what's the thing everyone talks about online, on the blogs, on the podcasts? What are they all talking about? IRA to Roth conversions. I better do that first. That's an inefficiency because it's the sequence is out of order. You're missing different opportunities. And what the research found was tax efficiency. Those who properly understand how to weave long-term capital gains into income and then maybe stepping and doing IRA distributions at income on a different year, or understanding how tax loss harvesting actually works, not just going in there and selling a few stocks at a loss and moving on, but how it actually works. Those who understand this have seen anywhere from 0.3% to 0.75% of additional growth of their portfolio throughout retirement. That's significant. Not only are we increasing performance, not promissory by, let's say, the market. We cannot control the market. But we're controlling something that we have control over, and that's where we take our income from. And that leads to an extra, let's say 0.5%. Do you know what an extra 0.5% does?
I mean, it doesn't sound like a lot, but
That's like an extra $1 million in your legacy.
yeah.
0.5%.
Wow, that snowballed.
And that's just one, yeah. That's just one of them. And that's just a couple of tax efficiency strategies that a lot of people don't realize because taxes are complicated. So there's the first one on the list. How'd that sound? Put it in the chat for those who are joining us live if you want me to dive into more in tax planning here. I'm going to answer the questions as long as they're submitted. First come, first serve. But this is why I didn't just write the book, How to Retire on Time, by the way. I wrote the book to teach you a principle on how to manage a portfolio throughout retirement.
Yeah.
I created the guide. Let me just pull this up real quick. The Retire on Time workbook, which you can get on retireontime.com. So if you guys haven't done it, go there. You can buy it. We'll actually mail it to you, the physical copy here. But I've got several pages on just tax risk, things you don't know. And then there's an entire section in the book that walks you through your 1040, your tax return, to help you find those efficiencies. And you know what's really cool today? We've got AI that can explain a lot of this stuff and bridge certain knowledge gaps between the book, asking the right questions, pointing out, I see I've got on line 2A, tax efficient income, but that's actually upsetting this and this on your portfolio. Or I see on my tax return line 3B, there's a huge number there, not in 3A, but 3B. Oh no, like I'm paying ordinary income on dividends when I could just shift that over and pay long-term. All of these things are in the workbook.
Okay.
That's why people hire us to do a one-time plan. It's not just to find a better portfolio. It's to find a better tax-efficient portfolio, a strategy, a written plan, which, by the way, a written plan is what gives people more comfort than anything else in retirement.
Yeah.
It's not having a smart advisor. It's a written plan with maybe a smart advisor.
Yeah.
Anyway, we want to keep going?
Let's keep going.
All right. So the next one's Social Security optimization.
All right. I see it.
No one knows your date of death, but Social Security optimization, a lot of it is how do you get the most out of your Social Security? That's a true thing. So if you have longevity issues, you're probably not going to live past 75 years old. There is an inherent means, or there's a strategy saying, yeah, maybe you should file early. Be careful at 62 and 63 years old. You're taking it at an accelerated reduction of your benefits. So be careful of that. But if you find the right time between 64 and 70 years old based on your life expectancy, and you acknowledge the surviving spouse risk, and you acknowledge the tax efficiency risk, you could add potentially an extra 0.2 to 0.5% increase on portfolio growth. Something I don't think people fully understand is, yes, you might die before you file for Social Security. That's a true statement. No one plans to get hit by a bus. I don't know, what's another, you get the point. No one wants to die. But you don't plan like you're going to die tomorrow. You plan like you're going to die when it seems like it's right. And if things change, well, we don't have control over that. The point being is Social Security optimization, it's not just trying to get the most out of Social Security, because if you take it too early and you end up with longevity, that's a burden on your plan. Now, you might have less pressure on your portfolio, but you've got less tax efficiency. And I'll say it this way. If 60% of your income in retirement is from Social Security, you're way more tax efficient than if 40% of your income comes from Social Security, because Social Security is not totally taxed.
Yeah, in every case, it's never
It's never fully taxed.
Okay.
And it's not 0% or 50% or 85%. This is called the tax torpedo. So you can be in a certain category or a blend of the different categories, but if you create more taxable income, what you're doing is you're getting taxed on that income based on your tax brackets, but it also causes your Social Security to increase its tax rate as well.
Oh.
You're getting hit twice. So if you can have a larger amount of your retirement income coming from Social Security and longevity is in your family, and you did the IRA to Roth conversions correctly, and you structured the income around your standard deduction from your assets, you're blending it all together, you can get so much more out of your portfolio by minimizing your taxes, by blending Social Security as true optimization, and not the optimization where it's like, okay, well, here's when you die, here's when you can file for Social Security. Great, now let me sell you an annuity. Because that's really what happens in the industry, by the way. Most Social Security optimization reports that I've seen online are basically, hey, here's a free report. And look, we do it too. We created our own app to do this for you. If you buy the workbook, you get access to it. But they'll say, hey, here's your Social Security benefit. Great. looks like you need an extra $10 to $20 to $50,000. Let me sell you lifetime income because you don't want to retire and lose your paycheck until you've guaranteed your paycheck. Well, no, that's like one of 10 different ways you could solve income in retirement, first off. But that is often used because we like Social Security as an income stream, so it does transition well to lifetime income. But I digress. What I'm saying is Social Security optimization is not just a timing issue, it's a tax issue, which goes back to the other point. And so if we did that really, really well and maximize tax efficiency and maximize Social Security optimization, that could lead to an extra 1.25% in your portfolio. They call it the retirement alpha. That's significant. And you might be thinking to yourself, how in the world do I figure this out? That's a good question. And there's a lot of AI prompts that can help you start asking questions. But unless you have the softwares, unless you know the right questions to ask, unless you know what to look for, it's very difficult.
Right.
I'm not trying to be a gatekeeper. I'm just saying it is difficult. I've spent the last 10 years of my life focusing on how to figure out these efficiencies. It's not 1 + 1 is 2. This is like 4-dimensional chess. This is quantum mathematics, calculus, whatever.
And we expect everybody in America to be able to do this and figure this out for themselves.
It's so unfair. If everyone still had pensions, be easy.
Yeah.
Be way easier. But that's just not how it is.
Yeah.
Somewhere along the lines, we thought as a society it would be a good idea to get people to save into a 401k or something similar, grow their nest egg, and then put all the responsibility on them to just figure it out. I mean, I'll reverse it just for a second. I've spent my entire life in investments, finance, taxes, and so on. The last thing I want to do is become a healthcare specialist. Let's say a very complex profession when I'm 60 years old. I will pay a doctor for that.
Yeah.
It's just ridiculous. And also the fact that this industry is riddled with salespeople selling a product makes it even more difficult. You can move to and get fed for a year by how many annuity dinner seminars that you will get invited to, especially if you go to like the villages. You can get literally fed for a year. There's books on how to do this that teach you how to do this. Horrible for your heart health. But it's just, hey, file here. Now let's move on to selling you a product. No. Plan first, strategy second. And notice tax efficiency is a strategy. We didn't even talk about product. Social Security optimization, strategy, that's second. We haven't even talked about a product. It's so important we get this sequence in order. The next one I'm going to talk about is behavioral coaching. So this is very interesting, but just having an advisor that prevents you from panic selling, that alone, and just maintaining discipline when markets go down, could contribute around 0.5% to 2% of overall performance. That one thing alone.
Just not selling, not panic selling?
Just not panic selling, not locking in those losses, saying, oh, I'm going to try and time the market, and I'm going to just get out for a little bit, I'll get back in soon, and then you never do. I mean, I had a guy call me last year, very nice guy, says, hey, the markets are overvalued. I'm in cash right now. I'm trying to figure out how to get back in. I said, okay, how long have you been in cash? Since the pandemic.
Oh, yeah.
That's not a system, that's sentiment. And he was crippled by the fact that the markets were overvalued. And they are overvalued. That is a true statement. But just that behavioral coaching, having someone, it's kind of like in war. How's that for a segue? It's kind of like in war. You don't have necessarily the general or whoever's making the decisions on the front lines.
Right.
You want them back, protected, and in the calmest state possible so they can make informed decisions.
Yeah.
Because when you're on the front lines, when it's your money, it's tough.
Right.
There's that old Mike Tyson quote, everyone has a plan until they're punched in the face. When you see your $1.5 million go down 40, 50%, now it's $750,000, and you can't keep taking those withdrawals because you're not taking 4 or 5%, you're taking 7 to 10%. You panic. First off, that's not a good strategy. That's not a good situation to be in. but you're probably going to make some really dumb decisions too, because we're all human. You're not stupid. It's that you're panicked.
Yeah.
That's just how we are. So that's another factor of having either a written plan, which, by the way, I'm the guy that literally wrote the article, how a written plan or a comprehensive plan could replace your advisor and save you money and fees. You don't necessarily need an advisor. You need the discipline to follow a written protocol.
Yeah. Kind of like a recipe.
Yeah. I love recipes.
Yeah.
Good old cooking. So, all right. Should we keep going with this?
Yep. We
Okay.
got a couple more here. Or?
So, withdrawal sequencing, we talked a little bit about this with tax efficiency, but understanding where to pull, not just from a tax standpoint, but if markets are up, where to pull, and if markets are down, where to pull. Most people have a portfolio for when the markets go up, not a portfolio when the markets go down.
Oh yeah. So explain that. So if the markets are up, like what is my game plan?
Yeah. So let me share with you some advice. It's not really advice, it's social media influence.
Okay.
I probably get this clip emailed to me or texted to me or sent to me once a month from someone that stumbles across it. And I'll just say it's a guy that likes to walk around a lot and says, if I were to retire tomorrow, here's exactly what I would do. Then he claims to be a former financial advisor, which he was an English teacher that was like an advisor for a couple of months during a time where the markets only went up. But here's what he would do. He would put basically all his money in the S&P 500 because allegedly that beats most financial advisors. That's true. The S&P beats most financial advisors during the up years, but not in the down years, not in the volatile years. There's a reason why professionals use instruments to stabilize a portfolio, whether it's bond funds, buffered ETFs, or something else. But I digress. And he says, and I would just dollar cost average out of my portfolio every single month and be fine. Okay, let's just ignore the math of sequence of returns risk that if the markets go down, let's say 30%, you need a 43% return, which could take 2 or 3 years. And if you take 4% out, while the markets are down 30%, you're now down 34%. Your portfolio doesn't need a 43% return to break even. It needs a 50% return to break even. And if the markets actually crash, which historically they do every 7 or 8 years, and I have a whole long list if you look at my Kipling article about the market patterns that investors need to know, there are many 50% crashes, which means you need a 100% return just to break even, assuming you don't take income. It is proven that putting all of your assets in the S&P is not a good idea in retirement. Great when you're 20, 30, or 40.
Yeah.
40, you start to transition to something a little bit more strategic, dare I say. But understanding how to withdraw from your retirement is critical. And there's really 2 camps here. There's one camp where they are disciplined, like they are stoic. Marcus Aurelius' offspring. Okay? Little stoic reference for you.
Yeah, I love
for all the stoics out there. It's almost like they don't feel, they just do. Now, a stoic is in touch with their emotions, like they like nature and all, but they're not making emotional decisions. It's exactly what they're going to do. It is. Okay? And then there's other people who are saying, well, I'm learning how to do day trading. And I'll say, okay, how have you done? Terrible, but I'm getting there. No, okay, this ain't the little leagues. This is just your life savings that has to last. You need a system that you can follow perfectly. You just do it. Or you get a behavioral coach, aka advisor, to help you with this. But withdrawal sequencing, that can add an additional 0.2 to 0.5% on your overall portfolio. That's pretty good. Then we've got systematic rebalancing, and that's really just, again, sticking to your system, the portfolio discipline of understanding, is the market up, is it down, and then how are you rebalancing? So it's a system approach. That can lead to an extra 0.1 to 0.35% overall in a portfolio. And then the last one we didn't talk about is investments and or products access.
Okay.
You can't get, as a retail investor, a structured note. You can't get any insurance product on your own. You can't get access mostly to private equity, private credit, or a lot of those funds. You can't get, if you're a real estate investor trying to sell your real estate property and move it over to something that's more tax efficient and defer your capital gains tax, defer your depreciation recapture tax, you can't get a DST. 721 UPREIT, forget about it. What I've just mentioned were called Regulation D investments. For accredited investors, you have to go through a professional. So if you want to try and handle retirement on your own with only retail investments, you could be missing out on 0.15 to 0.45% of potential growth. That you could have had better returns by using stuff that you couldn't get on your own.
And why is that? Why is there sort of a gatekeeper? Why do you have to go through a professional for some things?
In my opinion, the reason why they have a gatekeeper for a lot of these investments and products is to help people not make dumb decisions. I'm not a doctor, but Tylenol is a great pain relief. Oxycontin, codeine, whatever the oxy thing is.
Those sort of narcotic pain relievers?
Yeah, I think they work better. I've never actually had any of the oxys. I've never had a surgery, so I've never needed them, right?
Yeah.
But I'm pretty sure like they're a little stronger. But there's also increased risk for addiction.
Yeah.
I don't know anyone that's addicted to Tylenol.
Right.
Just
Yeah. I have never met that person either.
yeah. But oxy is highly addictive. So when you got more on the line, so less liquidity or more complex on how the investment works, they're going to restrict access to try and help you not make dumb decisions. That's really it. And I think that's well-founded. It's not to get financial advisors rich on back-end commission deals or blah, blah, blah. It's to make sure that at least a professional who's willing to sit down and have a suitability conversation, a real one, not some little janky little like questionnaire thing you fill out and here's your portfolio.
Yeah.
Like actually get to know you as a person. That can be huge. Huge. So if I'm to summarize all of this real quick, and I see we got questions popping in here, so thank you for that. If you decide that you want slightly more efficiency in your retirement plan, by working with an advisor, according to the research by Vanguard, Morningstar, and InvestNet, that alpha could lead to an extra 1.45% to 0.55% of more out of your money. I'm not even talking about performance. I'm talking about just being smarter with your strategies and maybe access to a few more products that you could not get on your own. And this is one thing that I'm really passionate about. I think it's ridiculous, frankly, today, where you can manage your assets on your phone if you wanted to, that we have a culture of charging people 1% to 2% of how much they've saved as like a participation award, to where the client is the annuity to the advisor.
Yeah.
I mean, I won't say the company's name, but they may have had a multi-million-dollar marketing campaign basically saying, I hate annuities and you should too. So enter our stock market portfolio with a strategy that says, unless the markets are expected to go down by 20% or worse, you should be all in equities, which has some merit. I'm not going to discredit that. And we're going to charge you a percentage of your assets to have access to all of this. Well, how much does it cost to do the job?
Yeah.
I think that's a more fair question to ask.
And actually, you're answering a question that just came in. And so if I could just let you keep answering it, but this
please interrupt me. I get on tangents.
This attendee says, I am confused. If you are only fee-based, financial planning instead of acting as an investment advisor, charging 1.5% fees for AUM, how do you stay in business?
Yeah.
How do you keep paying me, David?
Yeah. So here's the simple math. Yeah.
Right.
How do I pay David? How do I run the business so you get your paycheck, right?
Yes, that's my take on this.
Yeah. So it's many conclusions we make aren't based on the evidence given. So it's very common for people to say, well, I charge 1% because our team is going to do way better. Like we're going to charge you more, but we're going to do way better than anyone else. Okay, maybe. It's incredibly expensive for a financial advisory practice to run custom portfolios for every single client. If you want a custom portfolio where you are sitting down with your advisor and you're handpicking out every single stock and you really want to be involved, we're not a fit. We're not doing that. We build systems. So when I say how much does it cost to do the job, We have modeled portfolios that you are either in or you're out. Now, it's not all your money in or all your money out. We have fixed costs on how much it costs to run this portfolio that's for retirees, or this portfolio that's, for example, our retirement clients and their grandkids, and they're trying to grow their Roth. We have different portfolios, but there is a fixed operational cost to run. Mm-hmm. So regardless of how many or how little clients there are, back in the day, it'd be incredibly expensive to run because we'd have to call and move all of those shares. Today, we literally click a button and all the portfolios are rebalanced based on the model.
Yeah.
And people won't admit to this. The profits of this business on that model continue to go up and up and up. And I'm saying, well, how much does it cost to do the job? Now, the flip side of it is if you don't have any money, in some sense, some people won't even take you, but like you might not have enough money to qualify for one of our models because it's a fixed cost. Now, this is the pricing for today. Okay. This is just today. Actually, I'll even announce one that's coming out next week.
All right.
How about this? So for your just investment management, for all the people that are out there that don't really talk to their advisor, they're just managing their assets, the portfolio, they might do a phone call and that's kind of it, just to check in. We charge $200 a month for that. That's it. Mm-hmm. We're not doing your annual reviews. We're not having ongoing conversations. We're managing your money with a very specific objective for those funds. $200 a month. That's it. To have access to our very sophisticated model that, participates in the market. Because the reality is the market makes you money, not the advisor.
Yeah.
That's just how it works. Now, if you're in retirement or near retirement, now I'm just doing the retirement versions. This is the new one. If you have $1 million, $1.5 million or less, the reality is your tax planning is easily solved with a one-time plan. The reality is your Social Security optimization, once we solve that, we're pretty much good to go. Like you do not have a complicated situation. And so once we build that plan, it's just following the system at that point. So we will have $400 a month, that's it, to maintain, we call it the retirement essentials. It's being technically, we're releasing it next week, but I'm just going to talk about it today. Because what are you doing? You're paying for our time to sustain all of the needed efforts, the implementation, the maintenance on an hourly rate, not based on how much you've saved for retirement. So if you've got a lot of money saved, we're cheap. If you've got 100,000 saved, we're really expensive.
Right.
We set our prices to sustain our business model. And it's up to you to either have saved more or less. Do you see how that reverses it? Are you paying a CPA based on how expensive your tax return is, or are you paying them for their time?
Right.
Technology's made this industry so efficient. Why are we still charging people based on how much they've saved? Why not charge for the job? And then for our private clients, the ones that have a lot more tax planning, the ones that have a lot more of a dynamic situation, there's a lot more. It's $600 a month. That's it. That is the most straightforward, transparent, and guess what? That allows us to be impartial to where your money goes. Should we put money into a CD at this bank? Normally, an advisor wouldn't be able to get paid on that because the money left the account, so they can't charge you that 1% to 2% on there. If that's the best place to put your money, let's do that.
Yeah.
Hey, you want to spend more money this year? Go ahead. You can afford to do that. It doesn't affect our paycheck.
Yeah.
It was the most liberating thing I've ever done professionally was go to a flat fee, like a membership model. Mm-hmm. So where I was going with this, though, is if you want the behavioral coach and if you want to have someone that you can talk to, there's different levels and different, things that we offer, certain things we don't. It just depends on the level here. And you can go to retireontime.com or kedrick.com and experience all this. Kedrick is KEDREC.com. You can look at these different tiers. You can explore which one's right for you. And we have the new question. Jake, if you put in the chat for us real quick, just for me, score.kedrick.app. You can all fill out this new questionnaire we just filled out. And what it does is it asks you a bunch of questions and it will say, based on how you answer this, you might be better off with a one-time plan, about $2,000, let's say, and you're good to go. We can do the tax efficiency, Social Security strategies, get you access to the investments or products that you wouldn't have had on your own. create your withdrawal sequence, what to do when the markets go up or down or when tax laws change, and then tell you, here's your systematic rebalance. If you can follow a recipe, just follow this plan and you're good to go. You don't need to pay ongoing fees. But for the people that have maybe more needs on behavioral coaching or their life might be more dynamic, they might want the ongoing relationship. We're good either way as a company.
What's the URL again?
Yeah, it's score, SCORE .Kedrick, KEDREC .app.
Oh, yes. Okay.
Not .com, .app. I'll
That
make
was
a
the
better
problem.
URL later, but when you fill it out, it's going to ask how much you have. It's going to figure out roughly how much do you have in pre-tax, after-tax like Roth, and then a brokerage account. It's going to ask you questions like when you plan to file for Social Security. It'll ask you questions like, have you ever sold at a loss? Do you consider taxes when you sell? Just a couple of really basic questions in there. And then it gives you a retirement score. Based on that score, it's going to put you into one of the different categories that may be right for you. It's all based on everything we just talked about today: tax efficiency, Social Security optimization, investment product access, behavioral coaching, withdrawal sequencing, and systematic rebalancing. The reality is, if we're fiduciaries, we're supposed to be this transparent. We're supposed to accept you where you are and who you are and support you based on where you are. I just created a business model that allowed us to do it without constantly favoring, hey, how much money can we get into our model so we can charge you 1% on all of it? I mean, it's like clockwork. Someone says, well, I'll give you 300,000. I'll give you $500,000, but I've got 5 million. Okay. And when they say, what, you're not trying to get all my money? No. If you want to manage those assets over there, go for it. Here's the expectation. Are you good with that? Yep, no problem. We become indifferent.
Yeah.
And if we're able to be neutral, that fundamentally has changed our conversations as a firm. It's so fun. Now, are we suited for the $20 to $50 million client? No. Could we service them? Sure. Is that our bread and butter? No. 20 million or less. We help a lot of people that have 300 to 800,000 with one-time plans. We teach them how to fish and give them a plan that has an extremely high probability of success. Really cool stuff that we can do. And then for the 800,000 to 5 million, that's really our sweet spot when it comes to ongoing relationships, because we're less than the typical 1% advisor, but we're typically offering more services because we treated this like a CPA model, not the, not the participation award model. Now, please understand, back in the 70s and 80s, when you had a lot of money, it was very difficult to move those assets, to call someone on the floor, to place the trades. Like, it was a lot.
Right.
But with the advancements of the computer, our job operationally has become very simple. The research is still a lot, but it's a fixed cost for us. So anyway,
I get that.
hopefully that was well received. All right, let's go to our next question.
Okay. And so walk us through the idea that if you're 50% down, why do you need 100% to recover? What am I missing? Why is the percent greater to recover?
Yeah, so let's say you've got $1 million, okay, and there's a 50% loss. You're at 500,000. Okay. What's 50% of 500,000? 250. So if you have a 50% return, your 500,000 increases by 250,000. You're at 750,000. So what's 100%? Or in other words, so when you talk about returns, it's whatever the number is plus 1 if you're doing the math. So 100% return really is that number times 2. So if in other words, if you're $1 million and you go down 50%, you're at 500,000. From that point, you need to 2x your portfolio. So 500,000 times 2 to get back to $1 million, that's 100% return. People do not get this. And the problem with it is we invented quantitative easing. That's a fancy way of saying we print money to get out of a crash quickly. That's one reason why we have a lot of debt. Now, there's a number of other reasons why we have a lot of debt, but I don't think people fully appreciate that. COVID would have been a terrible, probably 50% crash or worse. I mean, we shut down our economy.
Yeah.
But then things started to open. We figured out a way to get through it. We printed a ton of money. And so we were able to recover quicker. But what if that's not possible? You know, one of the funniest things that happened this year, if I can get political, and I will, because I can and I don't care, is when Trump tweets, Job reports have been better than, you know how Trump talks.
Yeah.
The job report's better than ever. No one expected this. What's the Shane Gillis joke? I walked in the room, I saw, that was the best report ever.
Yeah.
He's bragging about his jobs report that just comes out, and the markets are tanking.
Yeah.
He can't control the market. He can try to influence it. But when you see a massive surge of people getting hired, especially in tech, what does that signal? Oh, we priced AI wrong. What has caused almost all of the growth in the market over the past couple of years? AI. So if Trump or any politician right now grows the job market in the wrong way, or companies really politicians don't actually make jobs. It's business owners that make jobs, and politicians then take credit.
Yeah.
And politicians create an environment that's healthy or conducive for, I don't want to be too mean about it, but if we have the wrong job growth, that's a problem. If we priced AI wrong, this could be a very slow burn, just like 2001 and 02 was 3 years. Slow decay for 3 years, top to bottom 50%. And the NASDAQ was down like 80%. And then you need a 100% return to break even. That took a couple of years. We have forgotten what it's typically like. COVID, that's an event. You can solve that. But when you have financial, like fundamental decay in an economy, that's hard to fix.
Right.
And I don't think people fully appreciate the gravity of where we are right now in the market and how overpriced it is. When I look at Warren Buffett and Berkshire Hathaway, who is negative year to date, last I checked, they're managing their assets very, very well. The new guy, smart as can be. He just is patient enough to say, yeah, the markets are overvalued. We're going to wait until it crashes, and then we're going to buy the dip. But investors are impatient.
Yeah.
We want greed. We want money now. So all of this, and this is what I talk about for all of you who are listening. If you want to read my book, you can get it for free, retireontime.com. Download the book. It's book, audio book, or you can get my planning calculator for free as well. Chapter 3 talks about this in great detail. Chapter 4 talks about the solution. Some of your assets just need to be in what we call your reserves, assets that have growth potential but cannot lose money. It is probably more important now than ever before, especially for anyone that's within 5 years of retirement. I've got a class tomorrow. So this is on Wednesday the 24th. So everyone listening to the broadcast on the weekend, you just missed it. This is why you need to be on our newsletter so you can get access to our classes where I teach you how things are. We had a couple hundred people download my DIY annuity guide book this week. How to Retire on Time is a book that argues against lifetime income. I've been a huge critic of annuity for many, many years, but I'm teaching a class on when it's appropriate and when it's not. Half people they're going to attend it, and if you haven't signed up, sign up. You can email us or put in the chat that you want the link to it. But half the people are going to attend are going to confirm that it's not right for them, and what a great win that is. And the other half are going to say, oh, I didn't understand how it worked. Let's do it.
Yeah.
Let's do it. So anyway, that was a bit of a tangent here, but retireontime.com is how you get on our newsletter, how you download our books, which I give away for free because I want you to start asking the right questions. Okay. Can I pick a question?
Oh, yes, you can.
Coming right here. And by the way, talk about retireontime.com. If you're live here, you can always submit your questions in the chat. We do this show live on Zoom for anywhere in the country. If you're listening to the broadcast, you can also submit your question anytime. Retireontime.com/ask. Put it in there and you can catch the recording on YouTube later. All right. So the next one here is, which is better, an FIA or an FAA?
Isn't that the FAA? You go to the airport.
The Federal Aviation Association or whatever, or agency.
But that's not it. That's not what we're talking about, I'm guessing.
No. So FIA is fixed indexed annuity. It's a cash value insurance product, and FAA is a fixed annuity alternative.
Oh.
So on the surface level, that looks pretty, two annuities, right? Nope. This is deceptive marketing. Because you think, oh, these are safer or less risky insurance products, and the insurance company has to guarantee. And so, it should be.
Yeah.
Nope. Notice the subtlety of sharing abbreviations, which can confuse investors into making dumb decisions. And then you've also got the annuity alternative. So they put annuity in the word, so your mind goes to what it is. And maybe it's an annuity in the alternative investment space. Oh, this is fancy stuff.
Maybe some private credit, something.
Yeah, so I actually had this recently.
Okay.
An individual says, well, hey, she was asking about, index annuities and so on. She's trying to de-risk her portfolio because she's all in the market. That's a normal conversation.
Mm-hmm.
And so I explained how they work. I said, look, these are great as like a bond fund replacement, but they're not going to beat the market. You're used to really good returns. That's not what this is going to be able to do. I know a lot of people overpromise them. They hype them up. No, over 5 years, it should beat bond funds. It should beat CDs, but it's not a guarantee. You just got slightly more growth potential.
Yeah.
She goes, well, this FAA is going to give me, and these are her words, by the way. The FAA is going to pay out 8% of whatever you put in there every quarter. So 32% dividend, basically, every year.
And this is the FAA that she's quoting?
Yeah, fixed annuity alternative.
Okay.
Just for context, I don't know anyone that's ever had consistent returns or payouts of 32% other than 2 people.
Who are they? Do we know? Can you say?
Yeah. The Medallion Fund.
All right.
The cream of the crop, one of the best hedge funds ever that's closed. You can't get to it. It was like a group of friends. They would report things. They would report their returns, probably just to brag.
Yeah.
But like no one actually knows how they did it. And they could only do it because they had limited assets. If they tried to be a multi-billion-dollar firm or a hedge fund or these large ones that you read about, it would not be possible. Just like Warren Buffett's always said, if I had less money, I could make more growth. They limited the size to be able to have pretty good consistent returns. Now, did they do 32% or more? I don't know exactly. I just know that they are the best by a large margin. And then you got Bernie Madoff.
Oh.
Allegedly had some pretty good returns too.
Yeah.
That didn't work out. Now, I'm not saying this FAA, this fixed annuity alternative, is Bernie Madoff or a Ponzi scheme. I'm not suggesting that at all because I did read the prospectus. I did go through the details. It is a legitimate investment. It's not an insurance product, though. So how they can get away with this, calling it an annuity alternative, it's like all these securities people, all the investment people hate when people call an index annuity a bond alternative. Well, that's literally what it is. So now they're, I guess, tit for tat.
Yeah, sure.
But I read it, and you know what it was full of? High-risk private credit and distressed loans.
Oh, yes.
Junk bonds looked like a riskless asset compared to this thing. And when I broke it down to this person, they said, if I had a bleep button, beep. Like, had no idea because it was presented completely differently than how I read the prospectus. And I said, look, put this into your AI and ask it some questions.
Yeah.
This ain't sustainable. When the markets crash, when something happens, like this is not a long-term play. And you could lose everything. It's not principal protected either.
Right.
There's no guarantees on this. It's just going to pay out until it doesn't. It's like kind of like buying an Argentinian bond back when they were like 40% coupon rate, knowing that they would go bankrupt every now and then and just stop paying.
Huh.
How's that for retirement alternative?
Yeah.
I'm not saying that indexed annuities are good, bad, or indifferent. What I'm saying is it is indecent for someone to say, you've saved $1 million, now you're an accredited investor, and you can have access to all these fancier investments like what the wealthy do. No, it's not what the wealthy do. It's the marketing pitch that's intended to help people sell a product, a high commission product, that gets them to a risky asset or a risky situation, and they have no idea what they're doing. Yeah, these are real conversations that I'm constantly having because people are looking for a way to get more potential reward for the lower the risk might be. It just, for whatever reason, you can't cheat finance. You are compensated for the risk that you take. That is it. You can't separate it. The reality is you've got MYGAs. If we're going down the spectrum here.
Okay.
MYGAs, multi-year guaranteed annuity. It's guaranteed to grow at a fixed rate for a certain period of time. After that, it's whatever the insurance company is going to offer until you redeem it. Or a CD, which is a fixed rate until it rolls over into another CD or you redeem it, and it's whatever the bank's going to give you. Like they're kind of the same thing. Okay. Then you've got fixed annuities. Fixed annuities are a fixed rate for a year, but they can vary a year to year, and you need to understand the difference between the two. Then you've got indexed annuities, which are the insurance side, or you've got buffered ETFs, or you've got structured notes. The idea is you've got upside potential, but a less downside risk. Some of them are 100% principal protected. Some of them have a buffer or some sort of thresholds. They might take out the first 50% of your losses. But notice how we're going to the spectrum of fixed, lowest growth potential, highest inflation risk, but it's very dependable. And then you got a middle category. And the middle category is you've got growth potential, but it's not guaranteed growth potential. So you want to have that for a little bit longer period of time. And then you've got your variable rates. I'm not talking variable annuities. The stock market is a variable rate, as in it's going to go up and it can go down.
Right.
It can go both ways. And so that's where you got your stocks, your ETFs, your so on. And that's got the most growth potential. But notice you've got a spectrum. You can't get out of risk versus potential reward. So, all right. We've got just a couple of minutes left. What's the last question here?
Okay, last question. Shall we talk about how are you using buffered ETFs in your plans?
So buffered ETFs are a new thing that a lot of people, in my opinion, haven't adopted fully yet because it's new or they don't know it exists. A buffered ETF was possible because in, I think, 2019, the SEC changed the rules or updated the rules on what would qualify for within an ETF. And they're allowing now option contracts to be the underlying asset or mechanism of an ETF. That's a pretty cool thing. It's pretty significant.
Yeah.
And so then after a couple of years of people saying, hey, this new thing was possible, how do we do it now? It's been slowly, I guess, becoming more and more pronounced in the investment world space. I'll use the original one that I was familiar with. And that's, you might have like up to 7% growth. So if the S&P goes up, you get like up to 7% on the upside. But the downside buffer, like a max buffer, that will change every year based on how expensive the option contracts are. So in 1 year, it might be like a 40% downside buffer. So if the markets go down 40%, you don't lose anything. But if they go down 50%, you lose 10%. Do you see how it's once you cross the buffer, you're on your own? Mm-hmm. But if option contracts are cheap or volatility is low, that means we're not scared about the market crashing. You can get 100% buffer, but those buffers change every year. And then you can get something like a more traditional buffer where the first 10% is buffered out on the downside. So if the markets go down 10%, you don't really lose anything. But if the markets go down 15%, you lose 5%. Smaller buffer, but you get like 14% on the upside. So more upside potential, less downside risk, and there's a whole array of them. That's pretty cool. But the value of the buffered ETF is based on the value of the option contract based on the time, like today, and then when it would become due, which would be on its anniversary. So it, in my mind, was the securities world response to the fixed indexed annuity. Not bad.
Yeah.
It's a pretty cool thing. Great for short term and for liquidity needs, but long term, you're going to get probably a better yield on an indexed annuity than a buffered ETF as long as you shop them correctly. And that's a whole thing, by the way. People don't shop them correctly. They get greedy looking for the best rate today, and then they get stuck with a crappy rate in 2 or 3 years. It's called renewal rate risk. So be aware of that. Now they've created different types of buffers, like a quarterly buffered ETF. So it resets every quarter, not every year, or dynamic buffers, to where you take like a max buffer or different thresholds, so more upside, less downside, or less upside, more downside protection. And then they blend 12 into one fund, so you get the aggregate or the average of it all, and it just stabilizes a portfolio. In my opinion, it's got more growth potential than a bond fund, but it does the same purpose of a bond fund, which is stabilizing the portfolio itself. So I prefer buffered ETFs in investment models and portfolios that are in the market to help lower the risk or stabilize it. But when it comes to like reserves, like if the markets are down, it's not a guarantee like an indexed annuity or you buying a specific buffer ETF that is matured. So you want to separate the two types.
Okay.
That makes sense. There's a lot of new products out there. It's hard to adopt something you don't understand. I mean, I had to do a significant amount of research to understand how these actually work.
Because when you first started in the business, were buffered ETFs, maybe they were a thing, but were they as prevalent and available? Were they as varied as
They didn't
are?
exist
Oh.
when I first started.
Yeah.
Yeah, you could only do it if you had millions of dollars and a relationship with an investment bank to replicate what a buffered ETF was.
Oh, interesting.
Now it's available to the masses.
All right.
And that's not one of those, they're taking advantage of you. It's the SEC changed the ruling that made it possible to package this up and make it more available to a large group of people,
Okay.
which is kind of nice.
Yeah, it is. When things work out good for everyone, it is nice.
Yeah, thank you, SEC.
Yes.
We appreciate our regulators.
Yeah. Sometimes they do a decent job.
And I think we'll end with that. So for all those tuning in, again, this is How to Retire on Time Live. I'm Michael Decker with David Franson here. Grab the book, How to Retire on Time. You can get it at retireontime.com. If you want to continue your retirement preparation in the comfort of your home, you can always buy our retirement planning kit. That's where you get the workbook, the AI prompts, the planning checklist, the book itself, and many other tech resources. So Social Security optimization, tax planning, and so on. I had someone tell me the other day they saved $7,000 this year because of the kit and understanding how tax planning actually worked. That's a pretty cool situation. So anyway, it's not guaranteed. Everyone's performance, blah, 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 disclosure, everyone's going to be different here, but continue the exploration, many resources at your pace, whatever is right for you. We'll see you same time, same place next week, or join our newsletter and join us live, and we'll see your questions here. Sorry we didn't get to all of them. We'll respond to your questions later and go from there, but it's a lot of fun. Dave, thanks for hanging out with me today.
Always a pleasure.